there's going to be trick questions where you may understand a particular part of it, but you may miss a step and you get it wrong just by selecting the wrong, answer. It's with multiple choice questions, you either get it right or you get it wrong. It's pretty as clear as cut as that. But I do have to give you, in my opinion, I still have to give you multiple choice questions to at least, give you practice on doing multiple choice questions. But in terms of the midterm and the final, those are our problem questions, short answer questions, objective type questions. Even if you don't, get everything, 100% correct, you'll still get points awarded for the closest you get to my answer. Again, that's on the midterm and the final. Whereas the quizzes, it's just you get, 10 out of 10 right, you get 100%. 9 out of 10 right, you get 90%. So that's how it's factored in. The first one had quite a few questions. There's a lot of short questions, I think, but I can see how, it can be tricky. So I'm going to go over the quiz. Make notes on your own. I'm not going to share the actual answer as you see it, but I will release the answer from Brightspace. As soon as I look at your scores, I'll release the scores, which you should already have an idea. Your score should already pop up as soon as you finish the quiz. It would automatically calculate it because it's on multiple choice questions. So in that respect, you'll see your actual score. But then I'm going to release the actual answer, either today or tomorrow. Probably not today, maybe tomorrow. Keep in mind that the quiz, your quiz had the same questions, but it was in a different order. Everybody had their own quiz. The questions were sorted, and it was resorted by user. So a lot of these questions are the same questions, but even like the answers were not, will not be A, B, C, D. It won't correspond to your actual quiz. So just keep that in mind. The questions are still the questions. The answer will still be the answer. It's not going to be your question one. It may be your question two. It may be answer C instead of D. But just focus on the concept. First one. Which of the following is not considered a primary source of tax law? Let's see. Hannah, what do you think?
IRS publications.
IRS publication. Everybody agree with that? Yes?
Yeah.
Yes.
All right, good, good. Let's see, next one. Mia, which of the following trial courts is payment of a tax deficiency required prior to petitioning? I'll give you a hint. There's two.
E.
B. Everybody agree with that?
No, E.
Wait.
One-
E.
Yeah, E.
E is the correct answer. It should be 2 and 3. And it should be 2 and 3 on that one. U.S. District Court and U.S. Court of Federal Claims. Correct. Next question. If a calendar year's taxpayer's 2018 individual income tax return is mailed on June 15th, 2019, the statute of limitations for the IRS to examine the return would normally run out on, let's see, Dan, what do you think, Dan?
I said B.
B, everybody agree with that? Yeah, it's the later of, either the due date or the filing date. Again, if they filed it before the due date, it starts on the due date. If they file it after, it starts June 15th. So it's 3 years after June 15th. So correct answer is letter B. Okay. Number 4. I can actually walk you through number 4, just to show you the answer. So Barry and Michelle have 2 daughters. I don't know how I think their daughters are older now, who are in high school. Both earn $75,000 each. They have, did I give you the standard deduction for this one?
Yes.
Yeah, I did give it to you, right? Yeah.
Yeah.
Yeah, okay. I was wondering if, because usually something like this, I just put the standard deduction on the board. All right, so Barry and Michelle, salary is how much? How much is the salary? Salary
150.
Yeah, 150. And that's our adjusted gross income, right? So what do we subtract? Standard deduction?
Yes.
Deduction of, what is it, 24,000? So what is our answer here? What do you think? should be
B.
taxable income. I'm gonna abbreviate. Yeah, it's B. It's 126. You didn't really need a calculator for this one. I think you could have done it without a calculator. Correct answer is letter B.
I have a question on that one.
Okay, go ahead.
Because, at first I thought it was kind of tricky because it was like the obvious, like the standard deduction take it because the itemized was less. However, for some reason, I kept thinking that I also, because of that dependence, that I have to subtract that child tax credit.
No.
I think that's the key word there is credit. That's a tax credit, so it reduces what you have to pay in taxes, not what you were taxed.
You know, yeah, that's actually a good point right there. And I wasn't going to cover that part yet, but since we're on tax deduction, remember the credits come after. You got to think about logically, step by step. Adjust again, gross income. Figure out everything that's considered gross income, that's what we're covering today. And then we take out exclusions, so everything that's considered gross income. And then again, we started talking about deductions, in general, and deductions for AGI. So then we take out deductions for AGI to figure out adjusted gross income. From adjusted gross income, we subtract either the standard deduction or itemized deduction. That equals taxable income. That's where we went. But what's the next step after we figure out the taxable income? And Matthew, was that you that hinted on this? What do we have to do with 126,000?
We will figure out what their actual taxable income is by the
Well,
state.
that's
And then once we have how much tax they've been taxed based upon their adjusted gross income, we'll apply to credits to reduce that.
correct. Let me share the screen real quick on the actual book real quick so you guys can see. That's the point right there. It's going to be just so you get an idea. So it was 126 tax rate schedules appendix, and I'll show you where the appendix is as soon as it pops up. Why is it taking so long? I don't know why it's taking so long. Again, in terms of the standard deduction, again, that number is given. Single is 12,000. Well, again, 2018 it was different. So single was 12,000, right? Head of household was 18,000, and married filing jointly was 24,000. Remember, it's always the greater of the two. You can't take both. Remember that you can never take both. It's the greater of the two. I don't know why this is not showing up. I'll get back to that. But yeah, Matt, you're right about that. I just can't see the screen. But once you figure out the taxable income, which is 126,000, we'll get back to this in a few minutes once the screen pops up. You figure out the tax liability. So you look at the tax rate schedule. If taxable income is between these two numbers, figure out what the tax liability. Remember when we did that? Once we figure out the tax liability, then we apply the tax credits, and that includes withholding. That includes withholding. So let's say, for example, and this isn't the case, but let's say on 126,000, we figured out the math, and we came up with, for the tax liability, $20,000. Again, I'm not saying that that's the actual tax liability. I'm just saying once we did the math, it's exactly $20,000. Then we apply the tax credits, right? It didn't ask for the tax liability. It only asked for the taxable income. Then we apply the tax credits. Do we have enough information to know which tax credits to use? No, we don't. Again, I didn't give you that information intentionally. Well, I guess you could, sort of figured it out. If the two daughters are they're both in high school, it's possibly the under 17 and a fourth, well, under 17, the $2,000 credit kicks in, right? So that'll be $2,000 for each one. But I didn't give you the age on purpose. Again, I wasn't looking for that. But what if they were 17? They were 17 and 18, perhaps. They don't get the $2,000 credit. Which credit would they get now? The $500 credit for other dependent. You do that after you figure out what the tax liability is. So that is true.
Actually, I
So,
have a question about that. I don't remember it explicitly stated, but for ages, we do it for the age of the individual for dependents at the end of the tax year, so like
That
December
is,
31st?
yeah.
Okay.
Yeah, yeah, that's a good point. So if they die or if they were born December 31st, they're considered living for the whole year. But yeah, if their birthday was December 31st and they turned 17 December 31st, then they weren't under under 17. They would be the $500 credit. So that's when yeah, it's whatever their age was as of December 31st. Something I just thought about. What do you guys? I don't know if I talked about this, and this does happen in practice a lot. What about if a baby was born and died the same year? Can they claim the credit, the applicable credit and the dependency for that year? What do you guys think?
No.
Yes, in
If it
that
died
case,
in that year, no, right?
well, actually, in that year, yes, you could claim him just for that year. Just for that year, you can still claim him. There's a regulation under 152. I don't remember the actual regulation, but it is on the 152 that's where it pertains to dependency that specifically addresses that issue. So one of the things that people believe was stillborn, babies, nobody gets an exemption with or credit. That's not necessarily true. They will get a social security number and they will be entitled to claim the tax benefit, generally speaking, at least, and for that tax year, just for that tax year. So let's say there was a stillborn baby that passed away December 31st, 2020. So just for that year, they can claim the related tax benefits. That will be the $2,000 credit. For 2021, no, they can't. However, there are people that try to cheat the system, even though that has happened. They'll use the same social security number the following year, or they'll give the social security number to somebody else. What do you think happens in that situation? It's possible that the return may get rejected, or it may not get rejected. It may get accepted, and the return gets electronically, and that person may get the actual refund. Remember, the IRS doesn't audit the returns once you submit the tax information. They audit the return after the fact. So something like that, because it's so easy for the IRS to verify that information with the Social Security office, it'll get flagged. If it's not immediately, it'll get eventually flagged during the audit process. Some people, they have tried to do that and weren't successful. But again, that's on a case by case basis. Also, think about this. Remember we talked about the married couple, the in 2020. What's their filing status that year? Married filing jointly, right? They can still do a joint return the year of the death. So that also applies for dependencies as well. So that's how that works. Any other questions on number 4? Again, I'll provide you with the standard deduction and tax rate tables. You just have to know what to do with them. Number 5. Which of the following is not considered a capital asset? Not considered a capital asset. Margaret, have I called on you yet? I don't think so. Margaret, are you here?
Yes, I'm here.
What do you think for this one?
Okay, I think I got that one wrong. I put down machinery and equipment.
Everybody agree with that?
Isn't it B?
Which one is not a capital asset?
That's what I
A.
thought.
D.
E.
D is a fixed asset, right?
Yeah, fixed
Stock
asset.
ownership?
What's the answer?
Letter D. Remember section 1221, the definition? Think of it this way. A capital asset is not defined in the Internal Revenue Code. Remember, it doesn't tell you what a capital asset is. It tells you what a capital asset isn't. A capital asset isn't accounts receivable, inventory, or fixed assets. That's pretty much the list that's according to section 1221. So again, a capital asset is not inventory, accounts receivable, or fixed assets. Out of that group, what's the only thing that we see that's not a capital asset? Fixed asset, right? The correct answer is letter D. Now with all the A, B, and C, again, just work on the exclusion part of it. It works by exclusion. Remember I told you sell your principal residence, and I'm going to ask you this, pretty much from this point forward. What are you selling? You're selling a capital asset. But what happens if you're selling a rental property? When you're selling a rental property, that's not a capital asset. That's a fixed asset, a 1231 asset. So just keep that in mind. When you sell stock in a corporation, what is that? A capital asset. When you sell your partnership capital interest, what do you have there? A capital asset. Remember, it works by exclusion. Letter D is the correct answer because that's a fixed asset. That's a 1231 asset. Number 6. The legislative process for federal tax bills originate in which of the following? Matthew, have you gone yet?
No, in the House Ways and Means Committee.
That is correct. Letter B. Correct answer is letter B. Number 7, this was interesting. Sam is unmarried and lives alone in a condo. He pays for all the support of his parents who do not live with him. His parents do not have any sources of taxable income. What is Sam's filing status for this one? Gabby, have you gone yet?
No, is it letter D?
Everybody agree with that? It is letter D. Remember, to be head of household, the dependent has to live with you, except for your parents. So long as you're providing more than 50% of the cost of maintaining their home, you can get head of household and claim them as dependents. Again, you got to provide over 50% of the cost of maintaining the home. So again, the only exception is your parents. So the correct answer is letter D. Number 8. Which of the following trial courts appeals to the U.S. Circuit Court of Appeals? Now, this one I have gone over it a couple of times. This one I'm going to tell you what it is. It's B, right?
Yeah.
U.S. Circuit Court of Appeals hears cases from U.S. Tax Court and U.S. District Court. Remember, I emphasized that the U.S. Court of Federal Claims has its own appellate court. It's still a Circuit Court of Appeals, but it's specific to U.S. Circuit Court of Appeals for federal claims. Again, that hears its own case. So think of it that way. U.S. Court of Federal Claims has its own appellate court. U.S. District Court and U.S. Tax Court will appeal to the U.S. Circuit Court of Appeals.
I thought they both were like, because in my note for the lecture notes, it's the both said Circuit Court of Appeals, and then like parentheses, one said regional, one said federal. So I thought that it was encompassing both.
Yeah.
Court.
Well,
I had the same thing.
But remember how I had mentioned it to you that the federal circuit court, but the thing is you can't take a, and I did mention this before, you can't take a case from the federal claims court and appeal to the U.S. Court of Appeals regional.
Oh no, I completely understand that they're like separate. I more just thought that Circuit Court of Appeals, I thought that was just generally, because aren't they both Circuit Court of Appeals?
You're right. There are both Circuit Court of Appeals, but one is specific to U.S. Court of Federal Claims. I guess that was a takeaway that I wanted.
That was a little ambiguous too. I just know that the regional circuit is usually just short into Circuit Court of Appeals. But like I verified this with a figure afterwards from the textbook. One says regional circuit and the other one says federal circuit, and they're both referred to as U.S. Court of Appeals.
Right, they are. Right.
I think this question is phrased ambiguously. If it said which ones appeal to the same circuit court, then it would be 1 and 2, because the federal U.S. Court of Federal Claims appeals to the Federal Circuit Court of Appeals. So I don't think the question is phrased properly. It was really misleading.
Well, I'm not going to change the answer because the answer is still, B. But just put it this way: if I were to ask you this question on the midterm and the final, which is very, very likely, that's where you would have to, draw that distinction. They're both, Circuit Court of Appeals. However, the U.S. Court of Federal Claims would appeal directly to the U.S. Circuit Court of Appeals. You can describe that. But
so when you say Circuit Court of Appeals, should we have how should we assume if you meant federal or regional? Because I think I just didn't know which one you're talking about, because it doesn't say to the federal court or regional court. Is one of them more colloquially just called the Circuit Court of Appeals, or?
Well, yeah, I guess you can say that. That's a good way of putting it. At least I guess in practice and other practitioners, when we're talking about the Circuit Court of Appeals, we're mostly talking about the Regional Circuit Court of Appeals. Remember how I had mentioned to you that again, I'm not saying that no cases are ever heard here, U.S. Court of Federal Claims, but there are some tax cases that can go there. Most of the cases go to U.S. Tax Court and U.S. District Court. So in practice, usually when people say the Circuit Court of Appeals, since most of the cases are really, in here, U.S. Tax Court, U.S. District Court, they're talking about the appellate court that hears cases from the U.S. Tax Court and U.S. District Court. I guess that's what I want you to at least start thinking of it that way, because you are going to hear that in practice, Circuit Court of Appeals. And I guess you could question it, and you're right, you're rightfully to question it. They're both Circuit Court of Appeals. But in practice, usually people refer to the Circuit Court of Appeals as the Court of Appeals that listens to cases from the Tax Court and U.S. District Court. However, there are some practitioners that would just say U.S. Circuit Court of Appeals and talk about both in general. The only, I guess, problem that I have against that, I guess, because I'm just a bit retentive when it comes to that. One hears one court, one trial court, and the other one hears two. But you're absolutely right. It is, regional, and it is, I guess, going forward, when I say Court of Appeals for Federal Claims, which appellate court am I talking about? The circuit, yeah, the Federal Circuit. So to just look at it that way, the U.S. Court of Appeals for Federal Claims, that's the Federal Circuit. That goes directly to the Federal Circuit. So just look at it that way. And I guess, yeah, I'll word it differently going forward. But on the midterm and the final, keep in mind that that's going to be, the question is going to be, describe the judicial system. That's where you're going to talk about the trial courts. And then you could, say, well, the U.S. Tax Court requires you to petition within 90 days. U.S. District Court and U.S. Court of Federal Claims pay the tax to the government. And then the whole appellate court process. And there you can actually make that distinction between, regional and federal. That's where, you're open to, talk about it in much detail. But that's on the midterm and the final. For this one, it's just, I can't, really, analyze each one. It was sort of intentional for this one, 8, but not. Let's move to the next one. Number 9. Which one is not an itemized deduction? Oscana.
Item E.
Letter E?
Yes.
Anybody have a different answer?
D.
Letter D.
You had a different answer on the quiz. It was employee business expense.
Yeah, employee business expenses. Yeah.
Yeah, because I would have said credit card interest is a clear standout, not included.
All right, so yeah, I did change it. So,
Because I put property taxes
But-
from the ones I could remember.
but think about this. So the list is still the same, except which one is not, like which one of these don't belong here. Kind of, it's not charity. And we talked about this list before. Think about the list of itemized deduction, and we're going to go over it and over it and over and over from this point. We talked about that since day one. Number 1 should be medical expenses, right? Next section. Number 2, we talked about this before. What can you deduct on your personal residence? We talked about this even last session. What can you deduct on your principal residence? So that's property taxes and mortgage interest, right? So again, taxes, that's your state income tax and real estate taxes. We did talk about that. Now, in terms of interest, the only interest that I talked about that's deductible as an itemized deduction is mortgage interest. And remember, we also talked about that when we started talking about vacation homes, which we're going to get into more detail today. The only thing you can deduct on your personal residence is property taxes and mortgage interest. And even when I went over my the sample research assignment, that's listed in there as well. Even if you're not familiar with itemized deduction, we did go over it enough for you to understand that property taxes and mortgage interest are deductible. Charity is an itemized deduction. That's deductible as well. Now, the employee business expense deduction, that's no longer deductible. So that's an item that's no longer deductible, but everything else is deductible. And that includes charity. Now, regarding charity, any reason why you picked charity? Oscana, any reason why? What was that? Who was that? Anything? Well, it's not charity. It's remember, charity. The question that came to me a couple sessions ago was not if charity was an itemized deduction, right? What was the question that was asked before? Is charity a if you think about it, and the question that was asked, can a S corporation deduct charity, right? And my answer was, well, not necessarily. And my explanation was the charity is not considered a business deduction, right? And even when I started going over business deduction, I said charity is not a business deduction. Charity is an itemized deduction. It's never been a business deduction. That's not to say that that a business cannot, make charity gifts. They could, but it's an itemized deduction. It's a personal deduction. It's still deductible. Itemized deduction is still deductible as charitable contribution. They actually even increased the ceiling amount on charity, and we'll talk about that in more detail. But again, what's the list of itemized deduction? Medical expenses, right? Taxes, interest, charity, and gambling losses. That's pretty much it. Remember that list. I want you to commit that list to memory because that's pretty much the only itemized deductions that you'll have until 2025. I don't know if it'll change after 2025. It all depends on whoever's in office, not just president office, also who's ever in Congress. So just keep that in mind. Right now, medical expenses, taxes, mortgage interest, charity, and gambling losses. But only gambling losses are deductible up to the winnings. So just keep that in mind. I'll say that list again: medical expenses, property taxes, mortgage interest, charity, and gambling losses. I guess to even make it a list a little bit smaller, it's pretty much medical expenses, taxes, mortgage interest, and charity. That's pretty much it. If you want to look at it, in that respect. But what about one thing I'm not covering? So we talked about mortgage interest. What about home equity interest? Something to talk about. We'll talk about that in more detail later. And that's something that we're just going to expand on it. But right now, the list is medical expenses, taxes, mortgage interest, and charity. That's it for itemized deduction. And again, now on the midterm, I will ask you a question that does contain itemized deduction, because even though we're not going to get into detail of itemized deduction until after the midterm, you have to understand the basics of itemized deductions. What are itemized deduction? And if the itemized deductions are more than your standard deduction, then we're going to take the itemized deduction. If your standard deduction is more, then we're going to take the standard. Number 10. Power, Lawrence Power. What do you think on this one? Robert and Sandra are still legally married, have been separated and living apart for 2 years. They have one daughter, Lorena, who lives with Sandra. What is the most advantageous filing status for Sandra? Remember, you're representing Sandra, not Robert. What do you think? Power. Lawrence Power? You here? You were here. You disappeared. No, there you are. Lawrence, are you still with us? I don't know if he left or what happened. We'll come back to you. I need you to participate. Who hasn't gone yet? Who wants to volunteer and answer here? Who I haven't heard from yet? Nobody knew. Anybody? I was gonna say, Lizette, you went already, right? Did you go already, Lizette?
No,
Hey, Lizette, what's the answer for this one? What is your answer for this one?
I think it was B.
Mary filing jointly, Mary filing. Well, that is available, but you're representing Sandra.
So it's C, head of household.
Yeah, head of household. Now, yeah, you're absolutely right on this one. It could be Mary filing jointly or Mary filing separate. But again, you will come across these type of situations from time to time. They lived apart. What is the best? I didn't ask what's the best filing status for Robert and Sandra. I asked what is the best filing status for Sandra. You're representing Sandra. Sandra comes to your office. She explains this situation. She's a single parent. She lived apart from her husband. They're currently either pending. The divorce is pending, or they're just separated. Whatever the case may be, they live apart. And the daughter lives with Sandra. On the facts alone, how would you advise Sandra? What filing status are you going to advise her to take? So just put it that way. If Sandra comes to your office, what advice are you going to give Sandra? Are you going to tell her to file Mary filing jointly or Mary filing separate, or what are you going to tell her to file? I had a house. Again, you're not representing Robert. You're only representing Sandra. So the best filing status for Sandra is head of household. But let's actually draw. It is head of household. But let's actually throw something else at you. Let's say you were representing both of them. Is there a conflict of interest there? Oh yeah, you better believe there's a conflict of interest there. That conflict of interest should be disclosed to both parties. I would not recommend an situation like this, but it does happen. Actually just thought about a couple of situations that I kind of want to get out of because a couple they're divorcing. I'd advise them, I can't represent both of you. I can only represent one person, and I usually represent the person that's paying the bill, whoever signing the checks. Actually, I'm sort of kidding about that. Whoever hires me first, that's the person that's the one that I usually go with. But you do come across these situations a lot. It's more complicated if you're in a predicament when you're representing both. You do gotta disclose that information. There's a conflict of interest because you can't effectively represent both parties. Ideally, it's better to just represent one party, but it's not always the case. Number 11. Number 11. Which of the following is an example of tax evasion? Lawrence Power, are you back? I need you to unmute. I need you to participate. We'll come back. Dan, did you go already? You went already, right? I think.
Yeah, I can go again if you need me to.
Yeah, go ahead, Dan. What's the next one?
For 11, I said B.
Yeah, that's the correct answer. Selling your personal car at a game but not reporting the gain. That's true. Remember, you have to recognize all gains, even the sale of personal assets, personal use assets. That's tax evasion. Letter A, this is pretty common. People do this a lot. They accelerate the property tax payments to try to itemize more. That's fine. And then letter C, you're just picking between one type of bonds to another type of bonds. Municipal bonds are excluded. That's good tax planning. We talked about contributing to a Roth IRA. Again, the same thing. That's not tax evasion. That's just tax planning. You're preparing for the future. Correct answer is letter B. Number 12. This one gets a bit tricky. So I'll do this one, but just I'll walk you through the facts. Lionel, a single taxpayer, filed a 2015 tax return on April 15, 2016. The tax return had a balance due that Lionel paid on January 15, 2017. In 2018, the IRS conducted the examination of his 2015 return and issued a statutory notice of deficiency on October 22nd, 2018. The statute of limitations for the IRS to collect on the assessment would normally run out on, what do you guys think?
I think it might be on the next
I
page.
said June 15th.
I'm gonna go with 2028.
Okay.
Yeah, there we go. Yeah, 28. When did the statute of limitations start? Again, we talked about this before because it got audited. If they didn't get audited, let's just start with that. If this taxpayer never got audited, when would it start? January 15, 2016, right? So 10 years from that date, right? So it would be April 15, 2026, right? Everybody okay with me on that one? The fact that they paid the tax later has nothing to do with the collection date. So that's just additional facts. But the IRS issued a statutory notice of deficiency, October 22nd, 2018. So the statute of limitations would then run out on 10 years after that date. Again, the statute notice of deficiency, I told you there are two key dates two key windows started around that time. The 90-day window to petition within 90 days to the U.S. tax court. And the other window that starts at that time is the window that the IRS has to collect your taxes. It starts when they issue the statutory notice of deficiency. Generally speaking, there are some other, dates. There could be extension, there could be jeopardy assessment that they may issue, but generally it's 10 years from the assessment date. So 10 years from October 22nd, 2018. Again, the answers were, shuffled differently on your quiz, but just remember it's going to be letter E for this one. Any questions on the quiz? No questions on the quiz? All right. Good. Well, good job, guys. You have no questions at all? All right. Let me stop sharing this. Let me share. I want to talk about We're gonna do chapter 4, 5, and 6 today. I don't think we'll get into chapter 7 until we're not gonna get into today. We'll get into next week. I want to do a quick review of chapter 6. This is deductions in general. Also, one thing I do want to direct your attention, the next couple of slides or the next couple of lecture notes, I actually grouped them by I grouped them by I guess topics. So it's not going to be by chapter. So this is chapter 6, just so you know. But the next one is going to be tax deductions for businesses. So that's going to contain a couple of chapters. So that's going to be 7, 8, and 9 for tax deductions for businesses. And then the lecture notes after that will contain personal and investor losses, which would be chapter 10 and 11. And then after that is going to be property transaction, and property transaction is going to be property transactions part 1, property transactions part 2, and property transactions part 3. They do coincide with the way it's on the syllabus. It's exactly in the same order that I have my lecture notes. So just keep that in mind. And then the last section, which would be personal tax credits and other taxes that taxpayers pay. So this is what we're going to talk about today. Again, a review of deductions and losses, deductions for AGI, hobby losses. In a little bit, I want to go over this entity table because that's something I want you guys to understand. I do want you to take a look at some of these articles. There are more articles now available, but these are the first few articles that came out this year as part of the coronavirus update. Again, right now I'm just doing a highlight of the expense deductions. I want you to become familiar with the deductions for AGI. Again, the deductions from AGI are your itemized deductions. Keep that in mind. Business deduction, we're going to revisit this over and over. Business deduction is ordinary and necessary expenses, but does not include the following items. Those items are not deductible. Again, that's not to say that you're not, you can't take out your clients, you can't make political contributions. That's pretty common in business, but that's not a deduction. Again, fines and penalties, that's not a deduction. Legal bribes, not a deduction. We'll skip over the hobby expenses. I do want you to know, but remember, hobby expenses, production of income expenses are temporarily suspended. See that list of itemized deductions? See how, over and over, we're going over itemized deductions. So you should be familiar with itemized deduction. Losses. General rule, business losses are deductions for AGI. Here are a couple examples. You sell your fixed assets, you have a business loss, may even include a net operating loss. One thing I do want you to know, we'll go over this later, but just because you have a net loss from your business, that's a net loss on Schedule C, does not mean you have a net operating loss. Net operating loss is a totally different thing. But if you do have a loss from your business, that can result in an operating loss, but it's not the same thing. But with that, doing the computing the net business loss from Schedule C is first, and then we have to figure out what your net operating loss is. But it's not the same thing. It could be the same thing if you do the math right, but not always. Now, deductions of non-business losses, it all depends on what type of loss. Capital losses are deductions for AGI, limited to $3,000. Casualty and theft losses on personal property. Only federal disaster area, that's an itemized deduction. And we talked a little bit about gambling losses. Itemized deduction, except if you're a professional gambler. Okay. Let's talk a little bit about this investigating business expenses. Now, this is where we sort of left off, and I just walk you through it very quickly. So remember, I said you got to start the new business, and then you amortize the expenses. If it's an existing business, it's just an ordinary necessary expense. If you don't start the business, then you don't get a deduction. Well, let's actually walk through a couple examples. Example 1. Let's say Ima starts bakery in July 2020 and incurs how much? Let's say 45,000 in startup expenses. How much can she deduct? In 2020, That's going to be question 1, and in 2021. So that's going to be my first example. I should have made these into additional problems. Example number 2. Same set of effects, but I'm going to say I'm paid $52,000 in startup expenses. Example number 3. Example 3, I'm incurred $56,000. I think some of you already kind of figured out what I'm trying to do here. We're trying to figure out the amortization for each year. So I hope you have a calculator and double check my numbers. I'm going to use my calculator. So the first year, so we're asking for 2021 for the first set of facts. So let's do 2021 or 2020. 2020. So how do you read it? Deduct first 5,000, right? Let me deduct first 5,000, right? So because they're under the $50,000, they can deduct $5,000 off the top, and then the rest gets amortized. What would be the rest? If they're deducting 5,000, what's left over? 40,000, right? You guys see how I came up with 40,000? 40,000 times 6 over 180 months, right? Why are we using over 180 months? Remember, you're amortizing it over 180 months, which is 15 years. So 40,000 over 180 months, or 40,000, over 180 months times 6 months, or times 6 over 180. What do I get for that year? I got 1,333, right? Any questions with the first one? So that equals a total. I hate when that happens. So what does that equal? A total of 6,133, right? How about for 2021? 2021, we're just amortizing. So amortize 40,000 times. But now what do we have? We don't have 6 months of amortizations. What do we have now? 12 months of amortization, right? So times 12 over 180 months, which if you think about it, should be double that amount that I just gave you. Should be 2,667, right?
Okay, so it's always a straight line amortization. You can't do like a different amortization scheme where
Like what else?
What was it? I can't remember the name right now, but there's one where you amortize more heavily in the beginning because you incur your depreciation. Oh, I'm thinking depreciation, not amortization.
Yeah, I was just gonna stop you there. I know where you were going with this, but I wanted you to think of where yeah, it's depreciation. And tangible assets. Well, first let me start out. Intangible assets get amortized. Fixed assets get depreciated. So that's number one. Now, whatever you learn in your financial accounting class, I want you to forget that. I'm kidding. Oh, well, sort of. Because here's one thing I want you to think about. Even though tax depreciation, we're going to cover that after midterm. Even though tax depreciation resembles straight line and accelerated depreciation, that's just for fixed assets. But you got to use, whatever the makers tables are, whatever's allowed for tax purposes. Now, you could use one method for accounting and a different method for tax purposes. So keep that in mind. But you're right in that accelerated depreciation is always going to give you, the most depreciation. And that's what tax depreciation usually follows. But this is, amortization. So you got to use straight line. Think about it this way: intangible assets and startup expenses are always going to be straight line. Something else is going to be straight line. We're going to get into more detail. Real estate is always going to be straight line. You can't use accelerated depreciation for real estate. And let me just share a story with you of something. I think along the line of something what you're explaining. I was representing this guy on an audit of the tax return preparer that did the tax return previously computed depreciation incorrectly. What it looks like he was doing for depreciation on real estate, it looks like he was using, as you described, accelerated depreciation on real estate. According to Section 168 of the Internal Revenue Code, accelerated depreciation is not allowed for real estate. Yet he still tried to claim it for real estate. Got audited, and then his client ended up, getting audited, and I had to step in and kind of explain what went wrong to the examiner. We ended up getting a good deal out of it, but nonetheless, it stemmed from the fact that they miscalculated the depreciation. It didn't make any sense to me either how he came up with that number. The only conclusion that I could come up with, because it was a couple years, let's say 2017 and 2018, I had more depreciation than 2019, something to that effect. And this is just real estate. I'm looking at it and I saw the error right away. It's accelerated depreciation. This is wrong. This is why I got picked up on audit. And sometimes that's all it takes. It could be one line item on the tax return, and then they're going to start questioning, a couple other items on the tax return. So even if this is, it's done straight line, let's say you try to use a different method that you learn in your accounting class, not your tax class, but a method that you learn in your accounting class, it will not be allowed in tax at all. We'll get into that in more detail, later in terms of depreciation and amortization. Basic is it's, two different methods. But just follow tax law. Don't try to. I do want you to understand accounting concepts. Don't get me wrong, but just keep in mind that this is a tax class. This is a tax class, but I do want you to at least understand, the basics accounting concepts. But we are going to deviate from accounting concepts. Like this is sort of a deviation in a way. Think about this. You would for accounting. When we're talking about intangible assets, you don't deduct $5,000 right away. You just amortize over whatever the useful life, right? When we're talking about intangible assets, accounting or taxes is a bit different. All right, any questions with number one? Everybody see how we did number one? We deduct, for 2020, we deduct the first $5,000 and then whatever's left over, we amortize. Everybody okay with that? That's how we came up with $6,133. Everybody okay with that? And then for the second year, we're amortizing it over, over 12 months. Wait, I think my math is right. 6,667. I don't want to use 2,666 because that's going to be an evil number, I hear. All right, question number two. Same set of facts, except it's going to be 52,000. Again, here's how it works. Let's get back to over here. We're deducting the first $5,000. It begins to phase out when expenses exceed $50,000. Expenses exceed $50,000. So that $5,000 that we're deducting first, we're going to reduce that dollar for dollar by the amount in excess of $50,000. So for the second set of facts, so for 2020, we're not deducting $5,000. We're deducting $5,000 minus $2,000, which is what? 3, right? You guys see how we came up with that? Again, $52,000 is $2,000 more than $50,000, right? Again, $52,000 is $2,000 more than $50,000. The $5,000 has to be reduced by the $2,000. Again, it's $5,000 minus the $2,000, right? So what's left over now? If we're subtracting the $2,000, we're deducting only the $3,000, subtracting $2,000 from it. What does that leave us with here? $52,000 minus $3,000. What do we have left over? 49, right? Okay, 49,000 times 6. Wait. 49,000 times 6 divided by 180. That gives me 1,633, right? So 1,633, 4,000, right? Everybody okay with that one?
I just have a question. So you still subtract from 52 the 3,000, even though you took off?
Well, you're always going to subtract what you take off. Again, let's go back to this one. 45,000. How much did we deduct right away? 5,000. What are we amortizing here? Whatever's left over.
Right.
Same thing
I
here.
guess I would have thought that it would be 47. Like you would take the 5,000 away from the 52.
No, but you're only using $3,000.
Okay. So then you take it away from, you subtract it from 52, even though you used 2,000 of it to get it.
Well, that's just for phase out limitations.
Okay.
But you're subtracting what you're able to deduct first. Remember, you have to account for, in this case, $52,000. How are we deducting $52,000? If you're doing it that way, the math won't add up. It won't equal $52,000. Over here, you have to amortize 45. So 5,000 deduct right away. $40,000 is amortized.
Yeah, that makes sense. Yeah.
And over here, 52,000 of the 52,000, 3,000 is deducted right away. 49 is amortized, right? Gives you 4,633. And then for the second year, we're taking a full year of amortization, right? 49,000 times 12 over 180, which should be double the, what would that be? Double the 3,267, right? Double the 1,633, right? Any questions with number 2? Okay, so the last one, I guess if you think about it, they're already over the phase out amount, right? Deduct nothing right away, right? Right? Everything is, again, they're already over $55,000. So if they're over $55,000, $55,000 gets amortized. Nothing gets deducted right away. So in this case, 55,000 times 6 divided by 180, 1,833, right? So 1,833, 1,183. And then again, for the last year, it's going to be double that amount because, you're doing it for the full year. Now with this one, I actually, kept the math simple. It's the middle of the year, but keep in mind in actual practice, the startup expenses could be towards the end of the year, towards the beginning of the year. That's when you have to do the prorate. Right there in this equation, I just did I guess just to keep it simple, I kept it in the middle of the year. So that's your startup expenses, and this only works if you start an actual business. If it's an ongoing business, everything is deducted. If you don't start a new business venture, then none of it is deducted. So just keep that in mind.
I have a question on that one.
Go.
Oh, I'm sorry.
I was gonna say for the second example, the 2021 should be 3,267.
Oh crap! Thank you. Any other?
On example 3, I just have a question. If it's 56,000, the expenses.
Oh crap! Yes, thank you.
No, it's okay.
I just did the math wrong. Is that what you were gonna ask me?
Yes, I was just confused where that $1,000 went. $1,000 went.
It disappeared. No. Yeah. Thanks for catch. I did that on purpose to see if you guys were paying attention. Yeah, that's it. All right. Nobody ever falls for that when I tell everybody that I did that to see if you guys were paying attention. I do make mistakes sometimes. I'm only human, right? So yes, that's correct. So it's 3,733. Well, I can't get that one right. So thanks for catching that. I once thought I was wrong, but I was mistaken. That was a joke. Okay. You didn't get that joke? I once thought I was wrong, but I was mistaken.
Well, I'll save that. That's a good dad joke.
Come on, give me some credit. All right. Now, these rules for deductions, again, let's revisit these. No personal deduction except for itemized deduction and tax credits. Now, again, the capital expenditures, we talked about this. Inventory doesn't get expense when you buy it. It gets expense when you sell it. Basic accounting principle, the matching principle. Fixed assets, again, you don't write off the fixed asset right away. You capitalize it and depreciate it. Tangible assets, same thing. So this section 263, it's governed on that, basic accounting concepts. When do you capitalize an asset and how do you recover the cost? It's different terminology for taxes, but it's still the same concepts. Inventory, even though that's a current asset, you don't expense it right away. You expense it when you sell it. Fixed assets, that's a long-term asset, so you're not going to expense it right away. It gets recovered over the life. Same thing for an intangible asset. So just remember, those concepts from accounting, they still apply here. Now, again, now with regarding 265, that actually pertains a lot to, claiming. Let's say I get a loan, and just think about the facts that I'm giving you. Let's say I get a loan, and I use the loan to pay my payroll expenses. The loan gets forgiven. Can I still take a deduction for payroll expenses if I'm using funds that are excluded from gross income? No, under Section 265, that's not allowed. That's a double benefit. If you think about it, I'm already benefiting from excluding it from gross income, the canceled indebtedness, assuming it qualifies. I can't later turn around and claim a deduction on the same source of funds. I say this, and it's always been a concept. Section 265 has always been there. The CARES Act refers to that, and keep in mind, part of the CARES Act, the payroll protection plans, and the SBA loans, some of those loans are getting canceled. So what happens to the payroll expenses and operated expenses that they're using those loans for? The big question is, and this is among practitioners and even taxpayers alike, they're thinking, can we get a deduction for it? The way I thought of it, well, no, that goes back to Section 265, and its answer is no. However, there's some practitioners that say, well, it should be yes, and I'm like, well, the code is still the code. Keep in mind that we always got to follow substantial authority of tax law. We got to follow the code first. Section 265, that's statutory. Even though some people may argue that the intent of the law was different, I'm looking at the code. I'm going to look at it as clear as day. The code is Section 265. On the current tax law, it's no. You can't get a tax deduction. However, I do see some. I guess I sort of agree on that the intent wasn't for the taxpayers not to get a deduction. The deduction was just to give some kind of relief. However, they did specify in the CARES Act that you can't get a deduction for this if we're going to cancel the loan later. That was in the code. People are pushing for it, including the AICPA, the Illinois CPA Society, another CPA Society, bar associations. They're pushing for Congress, more specifically the Treasury to issue Treasury regulations to change that. Specific on just the payroll protection bill and the CARES Act. Everything else with Section 265 will still apply. But as it stands right now, if you're using funds that are excluded from gross income, you can't get another tax benefit from it. Related party losses, you can't take a deduction for that. And then again, if you're paying, the bills for your parents, and your parents are responsible for paying the mortgage, you can't take the mortgage interest deduction, only unless you're on the mortgage. Because if you're paying their bills, you're making a gift and they're paying the bills. That's the way it looks at it. You can't take the deduction unless you're responsible and you're obligated to pay for it. This is what I want you to spend some time on, the vacation home. We're going to do a little problem in a little bit. Again, here's the vacation home. A vacation home is when the personal days are greater than 10% of rental days and greater than 14. Again, and these are the fact patterns. When it's rented less than 15 days, rental income is excluded and the expenses are personal expenses. Of your personal expenses associated with realty, which are personal residence, what's deductible? Mortgage interest and property taxes, not utilities, not depreciation. What if it's rented for 15 days or more than 14 days? The tax preparer needs to determine if it's a vacation home or a rental property. Here's like a little test. You don't have to commit this test to memory because this test right here is just the criteria that's under Section 280 capital A. But once you determine that it's a vacation home, because that's what we're going to talk about first, you have to allocate the expenses. The expenses are limited to gross income. A vacation home cannot have a net loss. Let me repeat that. A vacation home can never have a net loss. Again, it's limited to gross income. The expenses are classified into 3 different categories. Category number 1 is your interest and taxes. Category number 2 is your other expenses, and category number 3 is depreciation. This is how we're allocating, the expenses. Now, the method that allowed, we can either use the IRS method or the tax court method, which we're going to go over in a few minutes. In a few minutes, we'll go over it. Keep in mind that these deductions are deductions for AGI limited to the rental income. Whatever we're allocating to the vacation home deduction for ATI, whatever is allocated to the personal portion, well, then we got to figure out what's deductible. Again, expense allocated to the vacation home but not allowed due to the gross income limitation will be carried forward. Expenses not allocated to the vacation home are personal. Remember, only mortgage interest and property taxes are deductible. Hence, the only category that you should be deducting is category 1. Category number 2 and category number 3 for personal was ever allocated for personal is not deductible. Category number 1, 2, and 3 for vacation is deductible to the extent of the rental income. Now, here are your two methods, and we'll get into these in that I have on Brightspace. I like the tax court method. I'm going to test you on the tax court method. However, I do want you to be familiar with the IRS method. The IRS method uses the same ratio for all 3 categories. The days rented, that's the top number, and the total used days would be the bottom number. The total used days is the sum of your personal days and your rental days. Again, total used days, the bottom number is the sum of your rental days and personal days. And that's the same ratio for the IRS method for all 3 categories. For the US tax court method, the first category uses a different ratio. Is days rented over 365. And can anybody guess where I'm getting the 365 from? Does that number sound familiar from anything? 365 days should be what? How many days in a year, class? Come on, you guys, should I know this?
365.
Yeah, 365. So that's how we're prorating it. We're prorating it by the number of days available, which is your bottom number. That's a U.S. tax court method. That's just the interest and taxes. In a leap year, it would be how many days? 367 or 366? 366, right? So 366 in a leap year. But that's just the first category. The second 2 categories will have the same ratio. Now, again, what I want you to think about it over here, let's say I have, in terms of rental days, 10 days. Personal days, 40 days. It'll work in terms of if it's vacation home. So again, 10 days rental, 40 days personal. Let's see if it works for the vacation home. So 40 days personal, right, is greater than 10% of rental days. How much did I say my rental days were? 15, right? That's 10. That wouldn't work. Sorry. It has to be more than 50. Let's go with 20. Then in that case, that would work, right? It's more than 10% than rental days and more than 14. Then the vacation home should work. Let's do the problems. Maybe I think it would be better if I go over the problem so you can actually visualize it. Again, the problem that I'm going to go over, this is on Brightspace.
So you would typically want to use the U.S. tax court method because
yes,
even though it results in less interest and taxes for this portion, if assuming that you exceed the amount that you're allowed to deduct, it would allow you to deduct more of it from your personal.
yes, that's it. Exactly, that's it. Assuming that you're able to itemize, it would give you the opportunity. You're going to deduct, you're right, you're going to deduct less mortgage interest and property taxes for the vacation home, right? But that being said, that means you're going to deduct more on the personal side. Actually, you're sort of on something right there. So
This is why you might want to use the IRS method if you had a very high rental income, for instance, and so that you did not exceed your income in expenses. Is that right, or is that just?
Well, that maybe, but rarely would that even work. So just keep that in mind. Even if we're going to go through these examples in class, the ones that are in the book, but rarely would that work. Even so, keep that in mind that there's other categories to you do interest and taxes first. What's the next category? Other expenses. So even though you may still have some, you still have some income left over after interest and taxes, you can still apply other expenses. Then you can apply depreciation. most of the times on vacation home, there's always going to be a carryover for the most part. You know, for the most part, it's going to be a carryover. But I guess it's something else to consider. If they're not itemizing, again, so again, if they're not itemizing, and if they're not itemizing and they do have income to spare on the vacation on the vacation home, then yeah, it may be in the best interest to use the IRS method. But that's rare. So just keep that in mind. That is rare. Most of the times, it's not going to be, you know, well, I guess just analyze it by case basis. That would be my best, you know, thoughts on it. All right, let me share the new screen. All right, so these problems that I'm going to show you right now, there it is. Again, this is what we're going to walk through for the next couple sessions. We're not doing the net operating loss problem yet. We'll do that next session, I think. Depreciation, this is a good one. Section 179 works very similar to how I described the startup expenses, their phase-out amounts. We'll talk about that later. Rental activities. So just something to think about. Margin Homer have rental losses of $50,000. Can Margin Homer deduct these losses? Well, it all depends. What happens if their income is more? We'll go over that in more detail later. Those are passive activity losses. All right, here's the problem that I want to go over. Again, the answer is on Brightspace, but I'm pretty sure I have both solutions in here. So here are the fact patterns. And again, as I'm walking you through this, I want you to at least highlight some of the key figures. Sam used a family home for, so personal days is 30, right? Rental days is how much? 70, right? Everybody okay with that? And then we have rental income, $5,000. Now for the next, you know, once we start collecting the facts, I want you to start, I want you to at least classify them by categories. The first category, interest and taxes. What's the sum of those two numbers? Property taxes and interest, $4,000, right? So category number one has $4,000. Category number two, what's category number two? Other expenses, right? Which is insurance and utilities, right? So category number two is 2,000. What's the last category? Depreciation, right? So that's 8,000. Everybody okay so far in the classification? The first category is property taxes and interest, that's 4,000. Second category is other expenses, other than depreciation and whatever in the first category. That's insurance and utilities, and then depreciation. Yes, that has to be done in that order. You can't do depreciation first. It has to be done in that order. Mortgage interest, other expenses, then depreciation. I'm not gonna do C. I'm just gonna do A and B, but I'm gonna show you both methods aloud. Okay, let's go over the solutions. All right. Again, the solution is on Brightspace. Can you guys see the solution here? Okay, this is the tax court method. I'm showing you the tax court method so you can visualize what's going to happen in this particular problem. Remember the ratio. Personal days is 30 days, rental days is 70 days. On the vacation home, this is what goes on Schedule E, right? Deductions for AGI. So the $4,000 we're allocating over, the ratio is days rented on top. The bottom number under the U.S. tax court method is 365 days. So 70 over 365 days, of the $4,000, we're using 67,000, I mean, on the vacation side. Again, of the $4,000, I'm using 767 on the vacation side. What is left over? 3,233. Okay, that part. Okay, on the other expense side, this ratio, it's different. It's days rented over the total days. What are the total used days? 100, right? So I'm just taking 70%, right? So 2,000 over the ratio of 70 over 100, I get 1,400. I'm using 2,000, of the 2,000, I'm using 1,400 on the vacation home. What's left over for personal? 600, right? Now, here's where it gets tricky. The depreciation, here's where it gets tricky. Some of you may actually ask that the math doesn't add up, but in a way it does. Here's where I want you to do the math. 8,000 times 70 over 100. What does that equal? 5,600, right? Again, 8,000 over 70 over 100 equals 5,600. On the vacation side, we're supposed to allocate 5,600 for depreciation. Let me repeat that. On the vacation side, we're supposed to allocate 5,600. What's left over to allocate on the personal side? That's how we came up with the 2,400. Again, we got 8,000. This should be 5,600. So 8,000 minus 5,600, what's left over? 2,400, right? Well, 2,400. Again, you're thinking the math doesn't add up. Well, it sort of does. Rule number one, well, not rule number one, but one of the top rules on the vacation home, can you have a net loss on the vacation home? No. Expenses are limited to the income, right? Even though you're allocating 5,600 here, you're only using 2,833. Here's my explanation. Even though the 5,600 is allocated to the vacation home, only 2,833 is used. The excess, 2,667, that amount is still vacation. That amount is still treated as a vacation home. That carries over until next year. Everybody okay with me on that one?
How did you get the 2,833?
It's whatever is left over after these two. Again,
Okay.
5,000 minus 767, that equals 4,233. 4,233 minus 1,400 equals this amount. That's whatever's left over. Actually, that's a good question. Let's just change the facts a little. Let's say it was 6,000 here. How much can we actually use here? 3,833, right? You guys see it? I can only use whatever's left over. I don't know what's going on. No, I don't know what just happened. Let me try to, my laptop is acting up. Hold on. Let me open up that screen again. Sorry about that. I don't know why it just did that. Here it is. All right, so you guys see if I had this at 6, can you guys, oh, you guys can't see it. Let me share. Hold on. All right, so in this case, if I had 6,000 here, then this number will change, right? Right? You guys see that, right? Then the amount that I can use here would be 3,833. None of the numbers on the right-hand side, whatever is allocated to the personal side, will change. Whatever I can use here will change. You know, let's say, actually, let's make it a bit interesting. Let's say this is only $1,000. So what happens here? It's only $1,000. We're using the 767 here, but how much are we using for other expenses? And we're only using other expenses 233, right? The rest of it gets carried over. Of the $1,400 that we should have used, we're only using 233. You guys see how that works, right? Because you can't deduct the you can't have an actual loss here. Let me be, it's acting up. Okay. All right, everybody okay with how we got to 2,833 now? You know, again, it's based on doing the math step by step. Now, in terms of the personal side, over here, we're only deducting 3,233. These two on the personal side are not deductible. Again, on the vacation side, these numbers are deductible, but on the personal side, only whatever is attributed to the personal and as an itemized deduction. What's the only itemized deduction? Property taxes and interest. I want you to take a look again. This answer is on Brightspace. I want you to take a look at the IRS method and see what happens. Same set of facts, except the ratio is going to be 70 over 100 for each one. Do you guys see the only difference now? Net income is still 0, right? Well, the main difference on the personal side is this, right? We're allocating more here on the vacation side. We're allocating less on the personal side. These two numbers don't change. That's not deductible anyway. These two numbers are the only one that changes. 1,400 still allocated here. 5,600 should still be allocated here. 1,400 still here, but this is the main difference. Over here on the personal side, we're deducting 1,200. On the tax court method, 3,233. Which method would you recommend for your client if they're itemizing? This one, right? The tax court method. What about this one? Think about this one. This one is minimizing the itemized deductions. They're only itemizing 1,200 of itemized deductions. You know, the net result here is still 0. You know, and so I think, man, to your point, you see how in this essence, it doesn't. If you're using the IRS method, the net result is still 0. You guys, you see that, right? And not just Matt, everybody else. It changes the composition of how these expenses are classified. Rule number 1, net income should be no more than again, it should be positive, but you can't have a net loss. The only thing that changes is this one.
Yeah, so it would be a very rare case where the vacation home income exceeds the expenses, and your client would get more by not itemizing, like taking the standard deduction, and so it wouldn't matter to have a larger itemized deduction.
Yeah. And yes, again, it's something to think about, considering that we live in a day and age where more people are taking the standard deduction than itemized. So something to look at. It may not even make an issue. It may not even, considering that, it may not even make an impact to a lot of taxpayers. Nonetheless, I would still want you to use a tax court method just for practice, because even though it's for nowadays, it's more people are taking the standard deduction. I still like the tax court method, just for that purpose. So something to keep in mind. But this is just on the vacation home. We haven't talked about rental property yet. This is what happens when, if you think about it this way, it's again, they're using it personal and rental portion. When there's mixed use property, you may have a vacation home. Now, if it's 100% rental, then it's just rental property for the most part. So just keep that in mind. Now, one thing I do want you to think about, and this is actually pretty common to what's going on in today's economy, in today's environment. Have you guys ever heard of Airbnb? You guys heard of that? Believe it or not, I just did my first Airbnb a couple years ago when I went to New York. I did the New York Marathon, and it was, all the hotels were it was around that time, all the hotels were booked, and I found a very reasonable Airbnb near the finish line. It was nice, but again, as you know, New York is pretty expensive. There, everything is small. Real estate is small. But let's think about that for a second. This is the reason why I asked this question. The person that was renting her apartment to me, what type of property does she have? Let's assume that she only rented to me for over the weekend, and that was it for the whole year. And any other year she used it for personal purposes, or here and there. Yeah, she only rented it to me. Listen to the facts. She only rented it to me, only me, for the weekend. So that was only 2 days, right? Let's say 3 days. She rented it for 3 days for the whole year. Does she have a vacation home? Does she have rental property, or is it neither? I'll tell you the facts again. She rented. It doesn't matter the number or not. She rented, the number of days was 3. I'll say it again. The number of days that she rented to me was 3 days. What happens there? Are you guys getting it? Well, yeah, it's again, that's the rule. If it's less than 15 days, you exclude the rental income. She would exclude and that's absolutely right. It's a personal property. Well, most likely it's personal property, but you would have to ask additional facts. But most likely it's personal property. Her interest and real estate taxes are deductible to the extent that she can itemize. But I'm guessing that that's not what happened in her situation. I'm guessing, she's, the location was, pretty, prime location. So let's consider the fact that she does have frequent visitors, and let's say the visitors, it does constitute for it to be a vacation home. Then she would have to do this type of analysis. Can there be a case where somebody that has an Airbnb, could that be just exclusively rental? Or the other option is, can it be an actual business? Again, things to think about when you're getting those type of clients. It all depends on how often they're renting out the units. It's going to most likely either trigger some type of rental income depending on how many days they use it. Again, the magic number is 14 days. If it's rented for more than 14 days, and that also includes any bartering transaction. So if there's an exchange of something in exchange for rent, the triggering days is the 14 days. More than 14 days, there's rental income. You got to figure out if it's rent property, right? Except if it's ongoing. If it's an ongoing, business itself, it doesn't go on Schedule C. I mean, it doesn't go on Schedule E anymore. It may go on Schedule C. So a lot of questions that you would ask somebody who's in that line of business, a lot of times it's a vacation home. Some of the times it's rental property, and some of the times it can be just a separate business altogether. Something to keep in mind with those type of businesses or those type of arrangements. But you do want to, look at, Section 280, and 280A. You want to look at Section 61, 469, and even 162 as well, related to the business expenses. Any questions on the vacation home? Any other questions? No questions? All right, now I want to go over this business entity table. Now, even though I'm not gonna test types of entities, this table is on Brightspace. I do want you to at least have a general idea of what the different types of entities are. I'll revisit this again. I want you to have an idea of how these entities are taxed. This is covered in more detail in Business 215. Yes, I'm trying to plug that in to get more students to sign up. So let's talk about or sole proprietors. Sole proprietorship. Is there an entity level tax? Does the entity pay income tax? No. The entity does not pay an income tax. Who pays the income tax on a sole proprietorship? The owner does. There is one level of tax, and it's paid by the owner, not by the entity. It's paid by the owner. What other taxes can sole proprietorships pay? Self-employment tax. And that's something that we are going to talk about in more detail, in class. There's no way around it. If you have self-employment activity, you got to pay self-employment tax. Going back to the question that I just asked you, if that Airbnb is considered a business, there may be self-employment tax because it's a business. Again, if it's a business, there may be self-employment tax in there. Well, it's most likely going to have self-employment tax. If it's rental property, then it's just passive income, no self-employment tax. So it all depends on facts and circumstances. Again, sole proprietorship is a flow-through entity. The owner pays the tax. There's self-employment tax on the profit. So what happens if the owner, starts taking out draws? Or better question, in a sole proprietorship, can the owner take out a salary? No. Think about it. You're already paying your FICA taxes through payroll. You're paying your payroll taxes through self-employment taxes. Those are your FICA taxes. So an owner cannot draw a salary in a sole proprietorship. Can an owner take out a draw? Yes, an owner can always take out a draw. That draw that they're taking is generally tax-free because they're already paying taxes on the income as they earn it. Let me say that again. When they take money out, they're already paying taxes on the income as they earn it, not when they take it out. That's how flow-through entities work. Again, when sole proprietorship, as they earn the money, that's when they're paying taxes. When they take the money out, that's just a return of capital, generally speaking. Partnerships and S corporations are also flow-through entities. But for a partnership, let's get into the details. Again, no entity level tax. Who pays the tax on the income? Partners do on their share of taxes. Is there any self-employment tax on a partnerships? In some cases, yes. And I did put the material participation. Yeah, if you're involved in the business, then you're paying self-employment tax on your share of profits. And hey, can you please put your microphone on vibrate on silent? Donna, I think that's you. Please put your. Okay, that was her. I muted her. Sorry. She'll notice right now. Okay, so partners that materially participate pay self-employment tax, right, on their share of profits. Now, here's where it gets tricky. Again, we'll talk about this in more detail later. Can the owner or the partner take out a salary in a partnership? It's not called a salary. It's called a guaranteed payment. You don't run a guaranteed payment through payroll. It's treated separately, and that is subject to self-employment tax, but you do not run it through payroll. It's similar to payroll in terms of it's compensation for services rendered to the partnership, but it's not, you don't get a W-2. You don't run it through payroll. This is part of the K-1. This is all reported on the K-1. But you do got to account for the self-employment tax and the income tax. So in a partnership, they could take out a guaranteed payment. The guaranteed payment would then be deductible on the partnership return. Again, same thing as a sole proprietorship. If the partner takes out the distribution, that is tax-free because they're already paying income on as they're earning it. S corporations, pretty much copy and paste of partnerships and sole proprietorship. No entity level tax. The shareholders pay income tax on their share of profits. Here's a slight difference. No self-employment tax on an S corporation. Some of you are probably thinking, well, that could be better. Well, maybe, maybe not. It all depends. Facts and circumstances. However, just because they're not paying self-employment tax, if a shareholder performs services to the corporation, that shareholder has to take out a salary. Again, if the shareholder performs services to the corporation, that shareholder has to take out a salary. That salary is subject to payroll withholding, and you do run it through payroll. Now, again, facts and circumstances. If it's a new business and the business is actually losing money, then again, it's probably unreasonable for the corporation to still pay the shareholder a salary. Again, facts and circumstances. But if they are making money and the shareholder is taking out a draw, the IRS can probably say, well, some of that is a salary, some of it is a draw. They'll probably say all of it is a salary. So just keep that in mind. When it's a single member or a single only owner as an S corporation, think about that for a second. An S corporation by itself does not perform services, right? An entity by itself does not perform services. The employees do. Can a S corporation have no employees? Well, I guess it could, but then who's running the business? Something to keep in mind. Just common sense. S corporation should have to take out some salary. There should be some salary. There should be some payroll. Otherwise, there should be some 1099s. There should be some type of direct labor costs or indirect labor costs in this type of business entity. S corporations do get audited quite a bit nowadays, and a lot of it is reasonable compensation. If a corporation takes out a dividend, it's tax-free because they're already paying tax on the share of income. C corporation we'll talk about that in more detail in the entity and the corporate and entity tax class. I'll give you the basics. Corporations does pay income tax on profits. Shareholders also pay taxes on the dividends. Again, let me say this again. Corporation pays tax on the earnings. So do the shareholders. What's this called right here? When something like this happens, the entity pays tax and the owner pays tax.
Double taxation.
Double taxation. C corporations, for that reason, are not popular for smaller entities. For closely held companies, C corporations usually don't work for that reason. Usually S corporation or partnership or maybe a sole proprietorship would work. But because of that element of double taxation, it doesn't really work for smaller entities. It may work, but again, facts and circumstances. But again, Double taxation. I think you guys already know that about C corporations. These flow-through entities, there's no double taxation. Now, however, even though there's payroll taxes involved in a partnership, sole proprietorship, and even in an S corporation, don't confuse that with double taxation. That is not double taxation. That's just FICA taxes. That's just payroll taxes. Totally different concept. Double taxation, they're referring to the income tax. The earnings are taxed twice. Payroll tax are payroll taxes. That's different. FICA taxes are FICA taxes. That's not double taxation. Now, again, here's the earnings. There's no self-employment tax on the C corporation. Well, who pays the payroll taxes? Same thing as an S corporation. If there's an employee that performs services to the corporation, that employee has to take out a salary. And distributions to the shareholder, well, that goes back to taxable dividends. Now, remember about the ordering rules for distributions. Not all of them are dividends. That's to the extent that the corporation has earnings and profits. So even with that, this gets a little bit more complicated. So it's not as clear cut as all the dividends or all the distributions are dividends. Some of them may be dividends, some of them may not be. We'll go over that in more detail in that class. Now, over here on this hand side, what do I have here? Limited liability company. Limited liability company with one owner. The default classification for that, it's considered a disregarded entity. Again, disregarded classification for that would be a single member LLC. The LLC doesn't exist for tax purposes, so it goes straight to the owner. So if the limited liability company had one owner and that owner is individual, then it just goes to Schedule C. The LLC doesn't exist. But what if that limited liability company had a corporation as the owner? The C corporate return or the S corporation return. What if the limited liability company had a partnership as one of the owners? Again, the entity can own shares. And in that case, it'll go on the partnership tax return. So what I'm saying is a limited liability company with one owner is dictated by the owner. So if the owner is a partnership, if the S corporation, C corporation, or a sole proprietorship, it goes on that return. The entity itself is disregarded. I know I just put sole proprietorship because that's sort of in simplest term. If it's an individual, then it does go as a sole proprietorship. What about the partnership? If it's two or more members, the default classification is a partnership. So even if one owner is a partnership, one owner is an S corporation, and one owner is an individual, one owner is a partnership, or any combination of that, it's still a partnership. A limited liability company with two or more owners, the default classification, it's a partnership. Everybody okay with the basics, right? One owner, it follows the owner, usually a sole proprietorship. Two or more owners, it's a partnership. One thing I want you to think about a limited liability company, it has the flexibility of being any type of entity. Remember, sole proprietorship for one owner, right? Two or more owners, partnership. What if I told you if a limited liability company wanted to the extent that they qualify, it can be an S corporation. You got to make an S corporate election, of course. What if I told you that a limited liability company, to the extent that it qualifies, most likely it should, it can be a C corporation. An LLC can be any type of entity. It can be a sole proprietorship, it can be a partnership, it can be an S corporation, it can be a C corporation. So it has that flexibility. So that's actually one of the benefits of a limited liability company as opposed to a corporation. A corporation, it can just be a C corporation or an S corporation. If you have an agreement with two or more people in terms of splitting the profits, you have a partnership. If it's just one owner, you have a sole proprietorship. Whereas a limited liability company itself can be any type of entity depending on the facts and circumstances. Now, one question that I get this a lot, and I'm sure you guys would get this question a lot. What type of entity should I form and which one is better? What do you guys think? Do you have a clear answer now, or are you even more confused now? What do you guys think? Thoughts, comments? It's clear, I think, but is it? What I want you to think, facts and circumstances. Never give quick tax, questions. There's no such thing. I even had a question today. Somebody asked me about a like-kind exchange. I'm like, oh my God, that's not a quick question. And this guy knows me, and I'm surprised he even texted me that. And I first told him, don't expect me to give you tax advice on a text message. Second, I need all the facts, and I'm gonna have to send you an engagement letter, and So that's what I'm working on. Of course, I'm going to bill him for giving him tax. I can't give tax advice for free. Now, where this goes, you are going to get this question a lot. Should you give them free advice? No, either include it as some type of tax memo, some type of letter, or include it as part of forming up the entity itself. But don't always go with limited liability company because that's the more popular one. Don't always go with S corporation because that's the more popular. Whatever the case may be, you gotta get all the facts. S corporation may work, LLC may work. LLCs are very, very popular right now, and it's because for whatever reason people like limited liability companies, and for tax purposes, it's very flexible. You can be anything it wants to be. One of the, I guess, also that I hear this a lot, and even to this day, people tell me this all the time, or I hear this through different conversations. Form an LLC, you'll save money on taxes. That is not true. Forming a limited liability company by itself does not reduce your tax liability. You may structure a transaction through an LLC, maybe set up differently, S corp, C corp, whatever it may be, to minimize your tax burden. But an LLC by itself does not limit your tax liability. Let me tell you another situation of this wasn't a client that one of my clients, but it was somebody that I almost took up as a client. I just couldn't really help him in this case. So the previous tax return preparer created an LLC because it's supposed to save him money on taxes. That's what he said. That's what the taxpayer did. Taxpayer didn't know the tax law behind it. He actually followed. The taxpayer ended up claiming employee business expense deduction. This is when they were still allowed. Schedule A itemized deductions. So he's supposedly an employee of this LLC, and all the expenses, this is how they were trying to write off the expenses. The expenses were written off through itemized deduction on Schedule A. Guess what happened to those Schedule A unreimbursed employee-related expenses? What do you think happened there? It got audited. That's not to say that he couldn't have a legitimate business. It's a possibility, yeah, you can always have a legitimate business. But one thing that the limited liability company didn't have, it didn't have its separate books. It didn't have a separate account. It didn't have anything separate. So on that alone, it's a disregarded entity, and it all flowed through the individual. It's still, he's still an employee of another company. He was an employee of this new LLC, and not just that, the whole employee business expenses were disallowed. He got hit with penalties as well. Again, there really wasn't anything I can do in that situation because it's the previous tax preparer gave him bad advice, told him that forming an LLC would save money on taxes. He didn't tell him that what he was going to do is try to commit fraud, putting employee business expense deductions when they're not an employee. That's fraud. It's not supposed to go there. But I've seen that happen a lot. Forming an LLC by itself does not minimize your tax liability. You got to be, better careful in planning. I guess what would have helped them in that situation, yeah, possibly the LLC is a separate business, have a separate actual business, not just for the sole purpose of minimizing your taxes. And it would have helped them if he actually had an actual salary. And it would have also helped them if they have some type of reimbursement plan. If they had a non-accountable reimbursement plan, that may actually work. Again, none of that was considered. It probably would have worked if it was structured properly, but just an LLC by itself will not achieve that. You can get yourself in trouble and get your clients in trouble for that. Any questions on this table? Anything you guys want to talk about in more detail? Any other questions? Are you clear, more confused? Any questions? What do you guys think? Nothing? Well, either you guys are understanding this or I don't know. Oh, my book is still not working. All right. Okay, hold on 1 second. Let me try to. I don't know what's going on with my book. Let me show you what I'm looking at. I have the. There it is. There it is. Yes, it's open. All right. So let's go over some of these problems. So we're in chapter, we started going over some of these problems last week, or last session, I should say. So last session we left off, we did go over some of these questions from chapter 4. Let me see, give me a second, it's loading up. We're gonna do 4, 5, and 6. All right, here we go. Yeah, let me know if I'm repeating some of these questions. We did go over some of these before. And this is chapter 4. Excuse there's a bit of a delay for some reason. I need better internet, better Wi-Fi, I guess. All right, here we go. Oh, question number 27. This is a good one because this one is defining the difference between economic income and is it gross income. And I'm also going to throw another question. Well, accounting income is gross income. All right, so economic income, that's just an increase in your net worth. Gross income is whatever's taxable. So the first one, J-Ron's employment contract as chief executive of a large corporation was terminated. He was paid $500,000 not to work for a competitor of a corporation for 5 years. Is that economic income? Yeah, I would say so. That's an increase in net worth, right? Anytime you have salary, that's basic accounting. That increases your revenue. If your revenues are increased, revenues are part of equity, right? So that increases your net worth. So I would say yes. Is the $500,000 considered income for tax purposes? What do you guys think? Yes. Again, unless there's an exclusion that tells you otherwise, that's income. So that's income for tax purposes. Letter B. Elliot, a 6-year-old child, was paid $5,000 for appearing in a television commercial. His parents kept the funds and put it in a savings account for the child's education. Is that $5,000 income to, well, that's economic income, right? To the Elliot. Is that income to the parents? No, right? Who claims this income on their tax return, the $5,000? I'll give you a hint, fruit of the tree doctrine. Who claims the income? Where's the fruit is the earnings. Who earned the money? Elliot. The parent cannot claim the income that Elliot earned. And again, fruit of the tree doctrine. Letter C. Valerie found a suitcase that contained $100,000. She could not determine who the owner was. Definitely $100,000 of economic income. Is that income taxable to Valerie? What do you guys think? Yes, it is taxable to Valerie. Letter D. Yeah, this is sort of an interesting set of facts. Wynn purchased a lottery ticket for $5 and won $750,000. The economic income is actually $750,000 minus $5. That's the actual economic income. Again, basic accounting equation. However, how much of it is included as gross income for tax purposes? The full amount or 750 minus 5? What do you guys think? Exactly, the full amount. Well, not because they don't qualify as it does unless I stated otherwise. It's not a real estate or a professional gambler. Again, you're only a professional gambler. It's pretty much that's all you do. You can't be a full-time accountant and then be a professional gambler. You're a full-time accountant. That's your livelihood. You're a recreational gambler. So just keep that in mind. But yeah, another way, then that's a good point. Larry spent, this one's an interesting one. Larry spent $1,000 to raise vegetables that he and his family will consume. The cost of the vegetables in the store would have been $2,400. Well, there is economic income of the difference, right? The difference between these two amounts, $1,400, that's economic income. Is that considered income for tax purposes? What do you guys think? No. There's no income for tax purposes here. He didn't make a sale. He didn't perform any type of services, not income for tax purposes. Economic income would be the difference, but there's no income for tax purposes. Letter F. Don purchased an automobile for $1,500 that was worth $3,500. There is economic income of $2,000. Is that income taxable? No, that doesn't trigger a taxable event. A pretty straightforward example. I think, what is income, what's not income. I think it's pretty straightforward. Unless there's an exclusion that tells you otherwise, it's considered income. And in terms of, again, always remember the fruit of the tree doctrine. In terms of this one, there was let's see. We did 35, right? Is this the one we did before, where it relates to constructive receipt? Did we do this one? This looks like we didn't do this one. Okay, yeah, it's when they mailed it. That one is considered. Oh, so we did this one. Yeah, we did do this one. Okay, that was income. All right, I want to get to some questions from chapter 5 and at least the vacation home. We did 39, right? Yeah, we did the 39. This is regarding the refundable deposits. Yeah, did we do? Yeah, we did 39 and 40. Am I correct? I think. All right.
We did 39.
And did we do 40? I think we left off.
I'm not sure.
Yeah, I think we left off at 40. Let's do
40.
We did do 40. Oh, okay. Can I just do it again real quickly? Again, I'm just gonna skim through the facts. Salary is $100,000. That's gonna be considered salary. You can't take out the garnishment at all. $100,000 is the salary. And then in terms of the dividends, $5,000 dividends belongs to the daughter. But this Swiss bank account, that's still his. That's still income. And also the $20,000 of salary. So $100,000, $20,000, and the $6,000, that's income to Rusty. He was trying to be creative and it didn't work. All right, let's do. Oh, 45. This is a good one. 45. Well, 45 is a divorce situation. I guess we can still ask the alimony question, but it's not income and it's not a deduction. Let's hold off on this one. It is well, actually no. Let's do it. The thing is, if it's alimony, it's not income because it's after 2018. Remember, the divorce becomes final in 2019 and future years. Not income to the recipient, and it's not a deduction to the person paying it. However, that's not to say that we're going to ignore whatever on the divorce decree. Always look at the divorce decree. So letter A. So what we're looking at, what are the tax consequences to Nell and Kirby? So letter A, in consideration for 1/2 interest in her personal residence, Kirby were transferred to Nell's stock with a value of $200,000 and $50,000 of cash. Kirby's cost was $150,000. The value of the personal residence is $500. They purchased the residence 3 years ago, $300,000. None of it is alimony. Remember, in order to be alimony cash or cash equivalent, it has to be in a divorce decree, and it has to stop when the recipient spouse dies or remarries. All of this is considered a property settlement, right? This is property settlement incident to divorce. So Kirby would transfer to Nell stock that's valued at $200,000. So that's a tax-free transfer to both parties. The cash is also tax-free. However, Nell would then have the basis of what in the house? The total basis. So the total basis in the house would be how much? The $300,000, right? Not how much it's worth. Even though it's worth $500,000, it's a carryover basis. Remember that table we went over? If it's a taxable event, we recognize in gross income the fair market value. The adjusted basis is the fair market value. Whereas when it's a non-taxable event, we don't recognize anything in gross income, and the adjusted basis would be a carryover basis, a net book value. So that's what we're going over here. Again, carryover basis. We're not going to use the fair market value. So Nell takes the residence at $300,000, right? And the stock, her basis would be $150,000, not what it's worth. And the cash is just cash. Again, the divorce became finalized in 2020. Now here's where it gets tricky. Again, we're still asking what is alimony and what is not, but keep in mind, because it's after if it's after 2019 or 2018 to 2019 and going forward, it's not income or deductible. But the definition of alimony is still the definition of alimony for tax purposes. So you always look at the facts. If I tell you the divorce became final in 2017, then it's income. If it's after the 2018, then it's not income. So in this case, Nell would receive $1,000 per month for 120 months. If she dies before receiving 120 months, the remaining payments will be made to her estate. Does this sound like alimony? Again, the second part of the definitions for alimony, cash equivalent, that's there. It's in the divorce decree, that's there. The last part, it ends when the spouse dies or remarries. That's not present. Is this considered alimony for tax purposes? No. Not alimony for tax purposes, not income either way, but it's not considered alimony for tax purposes. It will go straight to the estate. Here's what I want you to think about, because this all depends on when the divorce became final. So Nell is to have custody of the 12-year-old son, Bobby. She will receive $1,200 until Bobby either dies or attains age 12, 21, whichever occurs first. After each of those events, Nell would receive $300 per month. So how much is alimony? How much is child support? That's the question that I'm asking, or that this book is asking. Of the 1,200, how much would continue after these two events happen? The 300. So only the 300 is considered alimony. Again, that continues until Nell dies or remarries, right? $900 is child support. Neither one of them are taxable because, again, it happened after the divorce became final. But let's say something like this, the divorce became final in 2017. $300 times 12 would be taxable because that's alimony. That would be taxable to Nell. It would be a tax deduction for AGI for who was paying it? Whoever was paying for it. Child support was $900. No tax ramifications for that. Any questions on that one? Again, even though there really isn't any tax ramifications for any new divorces, you do got to read the facts. Okay. I think that's it for this chapter. Yeah, that's it for this chapter. Actually, no, let's do chapter 5. Again, remind me, we're still going to do that chapter, the question from chapter 3 that's still pending. So we are going to do that. Chapter 5. Again, I apologize, it's just going a bit slow. All right, here we go. There's a couple interesting ones here that we're going to do. Oh, what did I do? Here we go. All right, again, chapter 5. And we'll just get started with some of these, and then we'll do the problem chapter 3. Here are the problems. Yeah, that's a good one, but it's okay. Oh, here, okay, 33. Quick question on scholarships. What's only if it's tuition? That's the part that's excluded. And books and supplies also. Meals and transportation would be considered income. Same thing for 34. 35 is a good one. This is the one I wanted to do. 35 and 36, because that pertains to physical injuries, and it does happen a lot. Again, here's a review of physical injuries. For physical injury, only punitive damages are taxable. Compensatory damages are not. Non-physical injury, all the damage, all the recoveries are considered taxable income. So here are the facts. So Leah sued the overzealous bill collector and received the following amounts. So this is the damage to her automobile, 3,300. That sounds like compensatory damages. Physical damage to her arm caused by the collector. Again, that sounds like compensatory damages. Loss of income while her arm was healing, compensatory damages. Punitive damages. That's punitive damages. So letter A, what effect does a settlement have on Lee's gross income? Of these items, what's the only thing that's taxable? What do you guys think?
The 80,000.
Everybody agree with me on the 80,000? Yeah, that's $80,000. So again, only the punitive damages on a physical injury, only $80,000. Letter B, your similar facts. Okay, no, actually, no, not this is in a continuation of this. So she also collected 25,000 of damages for slander to her personal reputation caused by a bill collector misrepresenting facts to her employer. Is the $25,000 considered income? This is a non-physical injury. Yes, all of it is income. Non-physical injury, yes. Again, 36. A lot of these are pretty straightforward. This one, $150,000 in settlement of a sex discrimination case against her former employer. Is that income to her? Yes. Physical injury, non-physical injury, I mean, all of it is income. B, so this person now, $10,000 for personal reputation damages, and so total of $50,000. What do you guys think? Non-physical injury, non-physical recovery, what is it?
Income.
$50,000 of income, very good. But yeah, it seems like everybody's pretty straightforward on that one. Letter C is actually a bit of a different fact pattern. This is a recovery. Orange Corporation, an accrual-based taxpayer, received $50,000 from a lawsuit filed against its auditor, who overcharged for services rendered in a previous year. So this is a recovery of a tax benefit. All of it is income in this case, $50,000. More because it's a recovery of the tax benefit. They took a deduction one year, $50,000, and later recovered in the future year. So it's more of a it's I guess it's more of a trigger because of the tax benefit rule than anything else, because it's not really it's a corporation itself. Can a corporation actually be hurt physically? No, it can be hurt non-physically, but physically no. So it's all income. Next one, $10,000. Beth received $10,000 in compensatory damages, $30,000 in punitive damages. She filed against a tanning parlor for severe burns she received from using a tanning equipment. This is a physical injury. Which part is income? What do you guys think?
The 30,000?
Yeah, $30,000, correct. $30,000. $10,000 compensatory damages are excluded. Joanne, received compensatory damages of $75,000. Punitive damages of $300,000 from cosmetic surgery who botched her nose. Again, in this case, physical injury, only $75,000 is considered income. $300,000. Oh no, sorry, I read that wrong. $300,000 is considered income, right? not the compensatory damages, only the $300,000 damage. Any questions on these type of recoveries? It seems pretty straightforward, right? I think. All right.
Be beyond the normal scope. But you said like corporations can't have physical damages. But
Well, they
like,
can't.
well,
I mean, they could be.
I'm thinking of a
They can
case
be
where like
sued.
a landlord like locks the doors on a business, preventing it from doing business for a certain number of days illegally. Like that's a physically loss of income there.
No, no. What I mean itself, it cannot. It's because I guess it's not a real person. That's what I'm referring to. Because the corporation is not a real person itself, you cannot hurt the corporation physically. You know that again, it's not a physical person. It's not a it is an entity, but you cannot hurt the corporation physically. Can you sue the corporation? Yeah, you can sue the corporation. But can you hurt the corporation as well? Yes, the corporation can be damaged, but the corporation can be damaged or hurt or sued. You know, not for physical. You know, it's usually for non-physical. Recoveries. So again, a corporation cannot be physically injured, but on that, what you just said itself, the landlord of a corporation impose a restriction to its tenants, right? The landlord was acting as an agent. They can sue the landlord and they could sue the corporation itself. Yes.
I more think like say a bar, like a bar is renting a place. It's like a partnership, right? The landlord decides they don't like the bar there, and they lock the doors or like chain it up so that they can't operate out the space anymore.
Either way, yeah. Either way it goes. It's not a physic. It's a civil matter. It's not a. Again, it's what I'm referring to because I guess put it this way: can a corporation go to the hospital if it gets hurt? No, right? If something happens to you physically, you go to the hospital, you recover, you get bills, and so forth. A corporation itself cannot be injured physically. Now, I know what you're saying in terms of they're constraining the access to the building. That's one thing. But
Thinking about the loss of income, like that.
yeah, in either case, in that respect, in either case, if they sue, so if the owner of the bar, the corporation sues the landlord, the bar owner is going to have income regardless. Because again, it's a non-physical injury. It's a civil matter. It's going to be considered an income regardless because most likely that it's not going to be sued for physical damages. Did something happen to the bar owner physically where they're collecting? No, nothing happened.
Okay, so
Even if the bar owner was a corporation, nothing can happen to the corporation physically.
so it's a very special case that like when a person's physically injured and can't work, that their lost income compensation is
I
not
think you're misunderstanding the point. Physical injury means you're physically injured. That requires medical attention. Just look at it that way. That's what it means by physical injury. Physical injury is not loss of income. That's not a physical injury
No,
at
there
all.
was just a case in one of the examples that where the person was given compensatory damage for injury, and they were also given compensation for loss of income. And you said that wasn't taxed.
No, it's all income.
Oh, it is income then. Okay, I
Yeah, it's all
misunderstood
income.
something.
Yeah, everything is considered income because again, think of it this way. I guess look at it this way. In terms of recoveries from damages, the only time you're able to exclude something when it's a physical injury. Physical. Something happened to you physically. Your arm got broken. Somebody punched you in the eye. You got in a car accident. Those are physical injuries. A doctor can attest to the fact that you're physically injured. The mere fact that you're not getting paid is not a physical injury. Can you collect from not being paid? Yes, but you're most likely suing that person because of a civil matter, which is going to be considered income. Remember, keep in mind that also discrimination; those are civil matters. Again, they're recovering a non-physical recovery. The only time you recover a physical recovery is something happened to you physically. Just think of it that way. It's something happened to you that requires medical attention. You're suing because of that. That's income to you.
Okay, and then I guess I have a question about structured payments. Let's say a business was not paying you the full income say, you sue them. How do you determine the income there? Does it depend upon how they make the payments? If they pay
It depends on the
months,
origin. Well, no, it depends on the origin of the lawsuit. Why are you suing them for?
let's say that they were shorting your paychecks every month for 2 years. So it was over 2
Is that a
years. Of
physical injury? I think the question is still the same. Is that a physical injury?
no, I guess more meant when do you?
No,
recognize
just
the income?
answer the question. Answer the question. Is it a physical injury that?
This is separate from that. That's not regarding physical. You're going to be taxed on it.
Okay, yeah, that's it.
When do you recognize the?
When you receive it,
Okay, so when, it's all about when you receive it, not how it was structured,
right? When you receive it,
or not how it was incurred, rather.
yeah, it doesn't matter how. Yeah, when you should have received it is when you receive it.
It's only when you have the check in hand, basically.
You know, I guess the better way of putting basic rule, the cash receipt, the cash method of accounting. What is considered constructive receipt? You know, when did you actually, when did you actually receive it, or did an agent receive it on your behalf? No cash has been exchanged hands in your example. So there's think of it this way: the corporation gets no deduction yet, and the individual receiving it gets no income yet. When they actually pay it, then there's an actual deduction, sort of. You know, that's the best that I can give you right now.
Thank you. That helps.
Hopefully it's nothing in particular to your situation. Otherwise I was gonna say I have a couple of friends that are attorneys that are pretty good that can help you recover anything. But yeah, that's in terms of structured settlements, and that's for physical injury as well. Same thing. It's when received, and only the punitive damages are income. I think that's it for this one. All right, let's go back in time. I told you I was gonna do chapter 3. Did you guys go? I hope. Well, I'm not gonna ask. I'm hoping that you went over the chapter 3 problem. Now that we went over gross income in more detail, and I sort of gave you an idea of what to look at. Dan, hey Dan.
Not sure what happened there. I kind of cut out. Sorry. I had to restart that.
Oh, okay. No problem. All right, going back to the problem. Looking for my solutions. I don't have 21 solutions. Either way, the solution should be the same. I don't think the numbers change in the chapter, but let's take a look. That's not what I want to see. There we go. All right, all the way at the end. No, let me close it. Let me close this up again and open it. I don't know why it's going too slow. Let me open the 2021. Come on. Here it is. Oh, here's where we left off. Oh, was it? No. Okay, here, yeah, this is where we left off last time. Okay, here we go. Here we go. All right, yeah, this is the problem. It's about the same one in each one. We did go over these, highlight overview. Remember, for this one, the city of Albuquerque bonds, that's excluded. Everything else is income. Child support, not income, right? Annual gifts, not income. Now, again, I sort of hinted about this way back when we first started discussing this. The settlement from this this injuries, $90,000. This is a physical injury, right? Again, if you look over here, this is part of a physical injury. The $90,000, it's a transfer for personal injury she sustained. Is that income for physical injury? They're compensating her for medical expenses?
No.
No, it's not income.
Yeah, not income. So $90,000 not income. Lottery winnings is income. Is the federal income tax refund income? No, right?
No.
Only state refund can be refunded. It all depends. In terms of the itemized deductions, it looks like pretty much everything is deductible except life insurance is not deductible, right? Contribution to an IRA, that's deduction for AGI, right? Traffic fines, not deductible. Contributions to re-elect the mayor of Santa Fe, not deductible. Funeral expenses for Wayne Boyle, not deductible. And then again, information on the dependents. Again, in terms of the dependents, only one dependent is under 17, right? Do all of them qualify for dependents? So let's sort of look at that. Penny, oh, here's where it gets interesting. Penny, she's not under 19, she's under 24. Keep that in mind, under 24. Penny graduated high school May 19, 2018. During 2018, she earned $8,400, playing a harp in the lobby of a local hotel, and then other information. Oh, I thought it gave him from, well, I guess Kyle is a dependent for sure. Wayne sounds like a dependent, right? Does Penny qualify as a dependent, and under what rules? Qualifying child or qualifying relative? What do you guys think?
Qualifying relative.
Well, let's look at the rules on the qualifying relative. What's rule number 1 on the qualifying relative? Gross income. Gross income is more than 4,200, right? So not qualifying relative. Let's go back to qualifying child. Again, qualified child you should always apply these tests first. Relationship test is met. Age test under 19, right? Or what's the other part of the test? I keep forgetting. Okay, was she a full-time student in any part during the year? She was in high school until May, right? Now, here's how the tax law reads. It doesn't say that you got to be a full-time student for the whole year. It says you and this is actually pretty consistent with other provisions of the tax code that pertains to higher education. It all depends on if you were a full-time student for 5 months. 5 months out of the whole year. It doesn't have to be 5 full months, but was Penny a full-time student for 5 months? Yes. She graduated, so was a full-time student. Under 19 or under 24 and a full-time student. She was a full-time student up until May, right? Again, 5 months. That's your test, 5 months. So if the beginning of the May, end of May, doesn't matter. It's 5 months. She's still considered a full-time student. Remember, gross income is not a factor when you're doing a qualifying child test. Here are the rules again. Relationship, age test. Age test, we already determined that's passed. Self-support and home test. Under qualifying relative would be Wayne, the grandfather, right? Gross income is less than the 4,200 or whatever it is that year. Support is more than 50% by the taxpayers and the persons related to them or member of the household. So it sounds like Wayne qualifies. So let me show you the answer. Again, the book, the way I want you to do it, I want you to use the tax rate schedules. And you'll get a slightly different answer, off by a couple dollars. So just keep that in mind. I don't want you to use tax software because you're not going to be able to use the tax software. Again, like see this question, this is how you're doing the tax rate schedules. We went over this before. Okay, here it is. All right, here's the answer. I don't know if I have this on, no, this is an answer. I think I posted this on Brightspace. Double check if I posted the solution on Brightspace. Again, I want you to walk through this on your own using the tax rate schedules. But again, all the income is income only. And again, here it tells you what's not income. Remember, the Albuquerque bonds are not income. Child support, gifts from parents, injury, not income. Lottery winning is income. The IRA contribution, that's a deduction for AGI. That's how we got your adjusted gross income. Now, over here is telling you your itemized deductions. These are itemized deductions. However, the itemized deductions equal 17,400. Standard deduction for 2018 is $24,000. What are we going to take? The $24,000. So 98,100, which is your adjusted gross income minus the $24,000 equals taxable income of 74,100. Now they use the tax table. Again, I'm not going to give you the tax table. I'm going to look at the tax rate schedules. The tax rates schedules, using the tax rate schedule, it's going to be different. The difference is going to be by a couple dollars. So if you use a tax rate schedule, it may be something like 8,513 or 8,515. It's not going to be exactly what it shows up here. I do want you to use the tax rate schedules. You should get a number close to 8,500 and change. That's the best that I can tell you. What's the withholding? The federal withholding, not state withholding, only the federal income tax withholding, not FICA taxes. You don't get that back, only the federal income tax. That equals total 6,300. Again, the child tax credit, there was one $2,000 credit, right? That's for the child under the age of 17. And then we had those two credits, one for Penny, the full-time student, $500 there. And actually, I think that was it. Why? Number 10, did they not claim the? Why didn't they claim the? Why wasn't the father claim? Oh. Okay, she can claim the dependents. Okay. Okay, here's where it tells again, it tells you the fact that I just explained. It is a qualifying child. But why isn't the grandfather? What am I missing on the grandfather? It doesn't say.
He died.
Oh, I'm sorry. Yeah, it was right there. The funeral expenses. So yeah, that happened in the. Yeah, that's. Yeah, I'm sorry. I just missed that. Well, everything else is pretty there. I'm showing my age now. I tend to forget these things sometimes. So that's there. So again, the $2,500 credit that pertains to the child tax credit, $2,000 under the age of 17, and then the $500 credit for Penny, the full-time student. So total credits 8,800. The tax liability was 8,514. They get a refund of 286, right? Pretty straightforward. Again, I'm pretty sure this solution is on Brightspace. Double check on that. See if the solution's on Brightspace. And I do want you to. It is, right? Okay, so this is there again. When you do this at home, use a tax rate schedule. Do not look up the tax table. Your number should be a little different than it should be. It's going to be 8,500 approximately, but it's not going to be exactly 8,514. That's what they did with the tax table. That's going to be the number that you look up if you look at the tax table. The tax tables are based on the tax rate schedules that we've been going over in class, but we're going to use the tax rate schedules for the exam. Any questions on this particular problem? No questions? Okay, I think we're pretty much caught up with 4 or 5. We'll do 6 next session. We started covering 6 at least, so you should at least have enough knowledge with the lecture notes and at least with the problems that we went over regarding 6 and what we're going to do. We are going to start chapter 7 next week. But in terms of how much am I going to test you on the midterm, not so much on chapter 7, but I will cover it, but just not so much on chapter 7 for the midterm. That will be more on the final. But on the midterm, it's going to be everything up until chapter 6. The final is everything up until whatever we cover week before the final. Now, regarding the midterm, I sort of gave you an idea what to cover. You know, I'll be dropping more hints with the next couple of sessions. Again, you're going to have a judicial system question. That's going to be one of the questions. The legislative process, probably one of the questions. Or if you don't get that question, primary source of tax law. You know, out of those 3 items, you'll get at least 2 of those short answer questions. Again, the judicial system, primary source of tax law, and what's the third one I just said? Primary source of tax law and the legislative process. Well, at least 2 out of those 3 questions are going to be on the exam for short answers. Vacation home is going to be on the exam. We'll do a couple more problems from vacation homes next week. Tax court method, that's going to be on the exam. There's going to be one problem where you're going to tell me the filing status and the dependents and tell me if it's going to be the $500 credit or the $2,000 credit. So just, you know, tell me that. There's going to be another question where I'm asking you, I'm going to give you facts, going to ask you to figure out the gross income, AGI, and taxable income. And that's it for that one. And then there's going to be a even more comprehensive problem where it's going to be similar to this one, where I'm going to throw a lot of facts at you. You got to figure out what's relevant, what's not relevant, figure out the tax, adjusted gross income, number of dependents, all this stuff. It's pretty much what we did here. Figure out the itemized deduction. Even if they're taking the standard deduction, you still need to add up the itemized deduction. So that's going to be the problem that's worth the most points, about 40 points for that problem. Again, I think I'll probably do one more of these problems, tax return problems, so you guys can see how everything is put together. But you got to practice it on your own. Again, you should practice it on your own as well. Any questions? Any other questions? Anything you guys want to talk about outside of class, related to the class? Not related to the class? Nothing? What do you guys think? Nothing? I want you guys to participate. So because there's no questions, I'm guessing everybody's going to be prepared for the final, for the midterm. Is that correct? What do you guys think? Yeah, well, you better be if you're not asking me any questions. I'm kidding. I want you guys to ask me questions. If I get sometimes it takes a while to, digest the information. So take over the weekend. If you have any questions, start writing down your questions because the midterm is going to be sooner than later. The session before the midterm, that's when I'm going to do the practice quiz, and I'm going to release that practice quiz very, very. I'll probably send it to you right now. Yeah, I'll probably send it to you right now before I leave. So send.
A practice quiz or a practice midterm?
It's a practice quiz.
Okay.
Well, it's not a practice midterm because I can't give you a practice midterm. It's a practice quiz in that it's going to be short in duration. That's why I'm calling it a quiz. But just, again, similar format as the practice quiz I sent you before. That's what I mean. It's that type of quiz. But again, it just focuses on just, overall concepts that, you should look at. Again, it won't get into detailed questions. So I can't really give you a sample midterm. I guess the way that you just got to do practice on your own by doing all the problems, additional classroom problems, the problems that we've gone over in class. We've gone over the solutions. Some of the solutions are in Brightspace. So make sure you take a look at it, especially this one. This one is on Brightspace. I'll probably do the next one too. Any other questions? Go ahead.
How about the tax return project, the assignment or the paper?
What about it? Oh.
We haven't really. Yeah, like we choose any subject. I'm sorry, I saw it that is coming like in a month, I think, in 4 weeks.
Yeah, that's actually funny. Yeah, the tax return assignment. Actually, let's take a look. My computer's acting up. You know what I want to do? Hold on. Since I'm at 2 different places, I'm switching my computer. So okay, I'm in 3 different places. Oh, cool. There it is. You guys see the IRS website? Okay, go to the IRS website, 1040. Your 1040. Become familiar with these. I'm going to give you a quick review. 1040, this is your form. This is what you're going to use. Do not use the tax preparation software. You go here. Now, I think I have 2018. You can use either 2018 or 2019, but you would type it up, type in the information, so forth, and then fill out the information and so forth. Pretty straightforward. Keep in mind that you may need additional schedules as well. It's not just going to be this 2-page form. You may need Schedule A, and you may need a couple of different schedules. So at the very least, I want you to use the tax rate schedule. So you're going to have to give me a spreadsheet that shows me your tax computation. Again, you're not using tax tables. You're using the tax rate tables. I want to see your computation. There's going to be a list of items that appears as other income. Under other income, this is where you're going to use, again, Schedule 1. At the very least, it's going to be 1040 and Schedule 1. Again, look at the Schedule 1. Make sure that this is answered correctly. Now, I refer to line 21 as other income. What I'm actually referring to is line 8. You guys see line 8 where it has other income? And what you're going to put over here is C statement, whatever statement it is. Again, this is going to be other stuff that's considered income, but it's not a W-2, not interest. So like winnings from gambling or hobby income, that's going to be here. But you got to create a separate statement. That statement has to list all the items that's considered of income. You're going to have a total here. The total is going to carry over here. That's it. That's pretty much straightforward. The statement should have the name of the taxpayer, Social Security number, the tax year, and the form, 1040, and Schedule 1, tax year 2019. You have to attach a cover letter, and that's it for a tax research assignment. Again, you may need a Schedule A. Actually, let's talk a little bit about Schedule A. They're pretty straightforward. Schedule A, fill this out. Pretty straightforward, right? Here are your itemized deductions. See how it's pretty small? It used to be longer. Medical expenses, taxes, interest, charity. That's pretty much it, right? Gambling losses go on the bottom right here. You may have a Schedule B. The Schedule B it is triggered if you have dividends over 1,500. Where's Schedule? Here it is, Schedule B. So this is what you would fill out. Here's what I want to direct your attention to. People do not answer these questions on the bottom. Make sure you ask your clients these questions. I'm actually glad that you asked me some questions on the forms. At any time during the year, did the taxpayer have financial interest or did they have signature authority over a financial account? In other words, did they have the authority to sign a check of a foreign account? If the answer is yes, you make sure you answer yes. You may need to fill out other forms or not, but you got to make sure you're asking the client if they have any foreign interest accounts. This question, sometimes people automatically assume no. Ask your client if they have foreign accounts. If they do, make sure you disclose it properly. Because what can happen if you don't properly disclose these foreign accounts, you can be hit with a large penalty. It could be a penalty up to like 50% of your, account balance. So just, keep that in mind. It's a very hefty penalty. One more thing that I forgot about the previous Schedule 1040, Schedule 1. You see this question that shows up here real quick? At any time during the year, did you receive, sell, exchange, or otherwise acquire any financial interest in virtual currency? Yeah, you got to ask them that question too. This is a fairly new question. You got to ask them about foreign currency transactions. Again, these forms are pretty straightforward. You can type in the forms. This is what I want to see. Do not use an IRS, or a tax preparation software. I will know the difference. If you try to submit your tax return assignment with a tax preparation software, you will get a 0. Again, I want to see you actually trying to do it by hand. Again, I can't stress this enough. Sometimes the tax preparation software doesn't compute it correctly. So you have to understand at least how to do it by hand. If the software doesn't act up or if it doesn't, spit out the right result. You should know how to do it by hand. Even like more so, even in recent time, I found an error in the software that I use. I looked at it. I'm like, this doesn't look right. I did it by hand, and my numbers were correct. The number on the tax software was incorrect. So I want you to have at least, don't always rely on the tax software. Sometimes they can have it wrong. Any other questions on this? Any questions?
No, but I just want to let everyone know I did upload to the same YouTube channel Monday session. So you can look for that there to help fill in the missing recordings.
Okay, so thanks for reminding me. I'm gonna figure out how to send this to you. So I'm making 2 notes. Business 28, send practice quiz for midterm, and then send recording. Hopefully this works, and that again, I can't promise you how long it'll be available, but at least it'll be available, at least for enough time for you to prepare for the final. I mean, for the midterm. Actually, considering this is a condensed term, it may work. So again, my goal is to have it available, but I don't know if I'll have it available until the end of the semester. So definitely take notes.
And you can download from the link as well. I checked my work Zoom account, and we have a couple of recordings up, and you can download straight from the link.
Oh, okay. Hey, that'll work then. Okay, that'll work. Perfect. All right. Any other comments, questions, anything you guys want to share? Nothing? Nothing at all? All right, do I have Yeah, I was just gonna say that. All right, motion to adjourn. I need somebody to second.
Second.
Okay. Well, thanks, guys. Have a good weekend. Make sure you study the problems. Again, we'll catch up to chapter 6 by next Monday. So review up until chapter 6. Start looking at chapter 7. And I'll see you guys next week. Have a good weekend.
Thanks.
Thank you.
Thank you. See you guys.